Interesting to watch today that the Australian market is dragging its heels compared to the US market, and it does suggest we're going back to the same formula we've seen for the last 18 months, which was big tech dragging the US market higher, whilst the Australian market, which is banks, resources, and a bunch of domestic industrials, don't really show any growth. Resources have been downtrending now for well over a year, a big sector. The banks are a low growth, no growth sector that over a long period of time will go sideways. We've just seen the banks results season, there's no growth there either. So we have a market which has very little in the way of growth options until resources pick up, very little exposure to global companies. And then in the US, you have companies that have got a global customer base of billions, and the growth prospects from there have to be more attractive than Australian banks or Australian resources. So we are still in the strategy portfolio looking to increase US exposures longer term instead of sticking with Australian exposures. And the other little play here is the US dollar's dropped about 11% this year, and it has been fearing a recession in the US. If we're going to escape that, you might imagine the US dollar is going to start to recover, in which case, as an Australian investor, you want to be investing in things priced in the US. So exchange traded funds listed in Australia, which are investing in US stocks, are going to appreciate. Even if the share prices went nowhere, if the US dollar went up, the ETF price would go up. So a second kicker. We're not really here to play currencies, but that might help as well. So Australia, once again, if the market's going to recover and we're going to end up in a gentle bull market, Australia's probably going to get left behind again, in which case our strategy portfolio is going to look again to US-based ETFs.